Good afternoon, ladies and gentlemen. Welcome to Free Information Friday. And I'm delighted to discuss one of my favorite topics, year-end tax planning. As we approach the end of the tax year, effective tax planning is crucial for real estate investors. Analyzing your financial position now can help you maximize deductions and minimize your tax liability. So let's jump in. Year-end tax planning is all about analyzing your financial position and making the necessary adjustments to minimize your tax liability. Now, for real estate investors, this means analyzing your income, expenses, and investment strategies to ensure that you're taking an advantage of all available deductions and credits. So now I'm going to jump into giving you 4 simple tax strategies at the year end. Number 1, analyze your income and expenses. I tend to ask my real estate investors to analyze the expenditure side more heavily because I want them to see if there are any expenditures that they plan on making in the first 3 months of the next year, and then taking those expenditures and moving them back into the current year. By doing that, it increases your expenses, reduces your profit, thereby reducing your income tax liability. The second strategy is depreciation. I want my investors to comb through their portfolio property by property to make sure that they are in fact taking depreciation and that the depreciation that they are taking is correct. Number 3, utilize losses. I want my investors to utilize all of their losses, whether they can offset it against other non-passive income or passive income, depending on how they're set up, or simply to make sure that they're carrying those losses to the next year correctly. Number 4, I want them to purchase a retirement plan. I usually recommend that they purchase either a solo 401k or an SEP IRA. Now I'm going to give you a quick example of what I just spoke about. Let's say that you bought 2 properties. Properties A and property B. On property A, you had $30,000 worth of income and $15,000 worth of expenses, resulting in a $15,000 profit. However, on property B, you weren't that successful. Property B yielded $6,000 in income and $10,000 in expenses, resulting in a $4,000 loss. So let's use strategy number 1. We're going to accelerate expenditures. So what I'm going to have you do on property A is I want you to prepay $5,000 of next year's management fee. Now what that does for you, it reduces your $15,000 profit on property A to $10,000. Next, we're going to offset $4,000 loss on property B against property A. The result, $10,000 minus $4,000, now you're down to a $6,000 profit. And then from there, I would encourage you to purchase either a solo 401k or an SEP IRA for $5,000. That would also reduce your adjusted gross income by another $5,000. So in summary, I hope that you can see that real estate investors can analyze their financial position, which is their income and expenses, make sure that they're taking the correct depreciation, make sure they're offsetting their losses, and also to purchase a retirement plan. Now, I hope this information was helpful to you. And remember, if you're a real estate investor who wants to maximize their return on their investment, please book a call with our firm. And remember, only you can create your empire, but we are here to help every step of the way. Thank you, and I wish you much success on your real estate journey.